you're a short-term investor with goals less than 5 years away, this is probably a gentle reminder that you probably shouldn't be taking too much risk, unless it's with money that you can afford to lose. If there's a market crash, there simply isn't time for your savings to recover if you're too exposed to the stock market. Now, one way of gauging this might be to ask yourself the question, how much of a problem would it be for your plans if your investments were to fall by 20%? Would you have to cancel a holiday, a wedding, or would you even have to delay buying a flat or a house because your deposit had suddenly reduced in value by 20%? If that is a big problem, it's a fairly clear indication that you really shouldn't be exposed to equity market risk on your short-term savings. However, for long-term investors, perhaps saving for retirement, it's a completely different story. If you panic when the stock market sells off and sell everything, you crystallize your losses and will very likely miss out on the subsequent recovery. And that can have a lasting impact on your personal wealth. Think about the pandemic, which began 2 years ago. Markets quickly recovered to new highs within a few months, and certainly by the end of the year. It was the same with Trump, it was the same with Brexit, it was the same with the EU debt crisis, it was the same with the global financial crisis in 2008, and even further back it was the same with the tech wreck in 2001. Every time the market bounced back. Even if you had the foresight to get out before whatever crisis strikes, getting back in is psychologically very difficult, especially given that the most rapid gains are often made during the early stages of a recovery. So by selling out at the bottom and then not reinvesting until the market's recovered a lot, you are locking in a big loss and you have missed out on the strongest phase of the market. So there's the old mantra, which you've almost certainly heard, is it's time in the market, not timing the market. So even professional fund managers struggle with buying at the lows, selling at the highs. The young in particular will benefit from the two most powerful forces in finance, that is pound cost averaging and decades of compounding returns. Remember, if you're making regular savings into an ISA or a SIP, the lower the market falls, the more fund units your monthly contributions will buy. And at the same time, when markets are strong and even perhaps a bit frothy, such as we saw at the end of last year, your contributions will buy fewer units. So over time, on average, you'll be buying more when the market is cheap, less when the market is expensive. And the best thing about it is that you don't really have to give it too much thought. You just carry on doing what you're doing, investing in tax efficient vehicles such as ISAs and SIPs. Even older investors, though, should have a decent allocation towards the stock market if they're thinking in terms of funding possibly a 30-year retirement. Again, there's an old market law that if you withdrew 4% of your pot in the first year and then increase the withdrawal each year in line with inflation, the chances of you outliving your savings would historically have been minimal. This presupposed that the portfolio comprised 50% equities and 50% government bonds. And generally they found that the higher the proportion of equities in your fund, i.e. shares and funds, the lower the chances of you running out of money during your retirement. Today the safe withdrawal rate is probably nearer 3% because interest rates today are so much lower than when the 4% rule was first conceived. But the principle is the same. The more you have allocated to equities, the less the chance of running out over a 30-year horizon. The key issue, though, is diversification. Whilst markets in general tend to recover, some individual markets never do. The best way of dealing with such risk is an internationally diversified portfolio. Now, individual markets are always susceptible to what we call idiosyncratic risk that is very specific to those markets. Even the mighty Amazon crashed by 90% in the 2001 tech wreck, and many of its peers, older sort of listeners will remember, never recovered. They just disappeared altogether. And Japan's Nikkei 225 index famously lost 80% of its value between 1989 and 2008. And even today it remains well over 30% down from its 1989 high. So specific markets do get hit hard and stay hit hard. However, thinking in terms of a 30-year retirement, a global equity fund will typically have increased in value 6 times since 1992, ironing out much of the individual market volatility. Of course, no returns are guaranteed, but it shows the market's resilience to crises and how diversification can help cement that. The clear message to longer-term investors of all generations, therefore, is not to lose faith with equities in bad market conditions. For younger investors, market setbacks are an unambiguous opportunity, to allow the powerful forces of dollar cost averaging and compounding to work in their favour. But even for their parents and grandparents, they too can benefit from market weakness by topping up if they perhaps hold insufficient equity risk to minimise the likelihood of them outliving their pension pots, or simply by making sure that they're adequately diversified and not overexposed to specific risks. So we hope you found this useful, and please keep the questions and comments coming, and like, comment and subscribe this video and podcast. But until next time, please take care out there.